thank you all very much for joining me. This is a mailing list, FFTT mailing list only special event. We didn't let anyone else know we're doing this. It's an exclusive. So thanks for signing in. Thanks for joining us. We'll run through questions here for the next 45 minutes, as many as I can. And so I'm going to jump in here, starting with a question from Lee. Could you explain your dollar gold devaluation idea in a little more detail, please? Wouldn't the U.S. government have to buy all gold below the higher new amount to keep up the new price if necessary? The short answer is yes, they would have to probably make that market on an ongoing basis. But to explain it in a little bit more detail, the U.S. government's debt to GDP is, call it 130%. The problem once it gets that high is if they really want to raise rates significantly for any reason, say, for example, they want to control Bitcoin or they want to restrain inflation, etc. The problem is that significantly raising rates will put the U.S. Fiscal situation in a very difficult position right away because the debt to GDP is so high. And so step one, and whether it's now, whether it's down the road, step one has to be delevering the balance sheet at some point so that raising rates doesn't hurt the U.S. fiscal situation much more than it slows down the economy, create more problems than it solves. So one way of doing this would be if the Fed was told by Treasury, bid for gold. Roughly every $4,000 in gold is about $1 trillion. The mechanics of this, per the Fed operating manual, Federal Reserve Bank's operating manual, is that if the Fed was told to do this by Treasury, it would result in an account or a deposit in the Treasury General account with the Fed or the TGA. So every $4,000 is $1 trillion roughly in the TGA. Say we use 40,000 for round math, that's $10 trillion into the TGA, which the Treasury could then spend into the economy, assuming they do something relatively smart with it, infrastructure, et cetera. There would be, in theory, some measure of ongoing multiplicative effect to that. It would boost GDP immensely. And so then you would be delevering the economy. Your debt to GDP ratio would go down as your GDP went up. And in theory, again, if it's infrastructure stuff with a longer tail, there would be a multiplier, an ongoing effect that would then get debt to GDP down to a level where the Fed could raise rates significantly without bankrupting the U.S. government, in effect. So that's how I've thought about that. As I said, they would probably have to buy a gold on an ongoing basis to keep that market where they want that market to be, which again would be more liquidity. Next question from Eric: what is the possible influence of Basel III Accords on banking? I don't know what just happened here. Okay. It's just skipped on me here, so we'll go back to that other one. Thanks for hosting another Q&A. A question I have for you was on what were your thoughts on Grant Williams' interview with Paul Singer? Great interview. What about his thoughts about the Fed being completely clueless? A lot of our investment thesis ties around policymakers being in the know. Any thoughts on them just being so out of touch and tied up in the system, there's no plan and we could spiral out of control quickly? So I have printed out but have not read the transcript from Paul Singer and Grant Williams yet. I don't think they are clueless. I think particularly at the highest levels, when you get to the Fed chair, Fed vice chair, I think they are very tied in. I think the challenge is that they're effectively, they cannot go speak out of turn with the politicians. And so the politicians, that makes them, by transitive property, effectively politicians. And so I think they have to sound clueless. I think at the lower Fed levels, I think they in turn can't speak out of turn with the higher Fed officials. But for example, Harold Malmgren on Twitter, we had a conversation late last year, where I mentioned Stan Fisher, and Harold, who's been in Washington for 60 years, very tied in, said that Stan Fisher is one of the ultimate behind-the-scenes players in the world. So that was Fed vice chairman for a number of years under Obama and the early years of the Trump administration. So I don't think they're clueless. I do think that does not preclude the system from spiraling out of control quickly, but that's how I would answer that. Okay, so let me see here. Can you comment on the article about Tether being used by the CCP as a pump and later dump Bitcoin as a weapon against the dollar system? I thought that Nick Carter did an excellent job highlighting the lack of visibility in Tether and that is a problem. I think that CCP using it as a pump and dump. I know, we know that roughly 65% of Bitcoin are mined in China. We know that. We know that apparently in the offshore exchanges, Tether is used a lot more. To me, I think Tether is where I've come to on Tether is I think it's a near-term risk in the price for Bitcoin potentially, where if there is a blow up there, it could cause a problem in the short run for Bitcoin's price. With that said, I would be a buyer on that, because when you look at the domestic exchanges, to me, I think maybe the cleanest way to play if you really have a concern about Tether is you buy Coinbase on the IPO. Because to me, all the Tether concern, Coinbase doesn't use Tether, and it would seem like Coinbase would gain enormous share if anything happened or Tether was regulated. So that's how I've kind of thought of that. Let me move to our next question here. We answered that one. Okay, from Eric, what is the possible influence? Let me hit start answering. There we go. What is the possible influence of Basel III Accords on banking, on monetary situation this year? Will the banking Tier 1 regulation have an effect on the markets, currencies, trade, commodities, and precious metals? It might sound like conspiracy theory, but is it a part of the endgame solution? To me, what I've read so far of this net stable funding ratio as it relates to basically a separation of unallocated gold versus allocated gold and how they are treated, it seems like it has the potential to give preferential treatment to physical gold over unallocated paper gold. You've seen the LBMA squawking about it. You've seen that the Fed was meeting with the LBMA about this 3 years ago, which to me was very odd, given that consensus is that gold is irrelevant. The Fed doesn't care about gold. It's unclear to me why they would be meeting with the LBMA about this 3 years ago, unless it did matter. So I have not done enough research. I haven't been able to get my arms around enough what it means, other than there seems to be a clear delineation between paper and physical. That has the potential to be really good for gold prices, but I just don't know enough to say that this is it, this is a reset, etc. What catalyst do you think gold is looking for to resume uptrend? Seems like real rates continue to push it down. For me, it really is all about real rates in the short run. And then in the bigger picture, it continues to be about the U.S. fiscal picture and the U.S. fiscal picture needing increasingly negative real rates to basically keep the wheels on the cart, because the debt is so high, because the deficits are so high, because the fiscal picture position was so damaged by COVID, and because the entitlements are going cash flow negative, et cetera. So for me, I'm really in the short run watching negative real rates, which they've pulled off their lows, but they're still comfortably negative. There seems to be this consensus that they're going to be moving higher, and that the reflation trade. So I think part of it is whether or not the reflation trade and how that goes. I think if you get another turn down, you get another turn down in real rates. Then as the Fed is forced to come in and stimulate more, then I think you get another leg up. I think if the Fed is, as we think they will be, forced to resume yield curve control later this year, or not resume, but implement explicit yield curve control later this year, that I think is really the sort of turbocharged catalyst for gold that we're looking for. But for the moment, it doesn't seem like they're going to need to do that. And so all else equal, I think it probably just continues to sort of hang out where it's been hanging out. From Hussein, does Biden's order on new gas leases most likely result in higher oil prices, or do anything to prolong the life of the petrodollar? Said differently, does it change your idea on oil trades settled in gold? To me, when I think about the flows of it, anything that causes us being the U.S. to produce less oil, it increases our dependence on foreign oil, all else equal, which means we import more oil, we export more dollars. All else equal, that's negative for the dollar and should result in higher oil prices. In terms of changing my idea on oil trade settled in gold, the answer is no. Ultimately, that's with oil settled in gold is part and parcel to multi-currency energy trading, which if we look last week, the European Union released a draft saying they want to continue moving toward more oil pricing in euros. It would seem like Russia would be more than willing to do so. And in fact, actually already is pricing in euros. And so once you have oil priced in dollars and then marginal barrels of oil priced in euro and yuan, as is the case, basically what's happening there is not that oil is settling in gold directly, barrel for barrel, but ultimately, in the case of euro oil, in the case of yuan oil, it's effectively settling in European and Chinese goods. These areas run goods surpluses. So they make more than they consume, more than they import, with the exception of energy and other commodities. And so, to the extent there is a surplus left over of euros in places like Russia and elsewhere, and they want to deploy those into a reserve asset. To me, it looks like that reserve asset, at least one of them, would be gold, and that's ultimately how that fits in. So the short answer is I think higher oil prices, weaker dollar, all else equal. How would you look at the price of gold today versus the bottom in 99, even though it's gone up 6x relative to the debt? Is it still valued similarly? Any comments on the gold to oil ratio are appreciated as well from Mike. Yeah, if you look at where foreign held treasuries as a percentage of the market value of U.S. Official gold, we are marginally higher than we were in 99, 2000. So it's probably 6-7% of foreign held treasuries outstanding relative to, it's been a month or so since I looked at the chart, but I want to say it's probably 4%. 5% at the bottom in 99 or 2000. So you're still talking about gold collateralizing U.S. federal debt outstanding, the foreign held portion of it, at a pretty similar rate. And for pretty much most of history prior to 1989, that ratio that's 7% today was 20% to 130% in 1980. So still think there's a lot of upside there. Gold to oil ratio to me is really a function of the ongoing penetration or development of the multi-currency energy market, which, per my last comment, seems to still be developing both in China as well as in Europe. So I'd expect the gold to oil ratio to continue rising, all else equal, for as long as that happens. Can you explain the mechanics of how treasuries coming due can cause a crisis in the repo market? When the treasuries come due, the government has to cash the holders. So why does this cause problems for the banks? Why can't they just print it? My understanding is a significant portion of treasuries will roll over this year. So when to go back, I'll use the repo rate spike. I wanted to say last year, but we're moving fast. It was actually a year and a half ago. So September 2019, we had the repo rate spike, and the issue there was multifaceted, but ultimately it was a combination of too much issuance of treasuries at the short end, a lack of sufficient foreign buying due to FX hedge treasury yields being negative, an increase in the amount of the treasuries being financed by highly levered players like big hedge funds who were hurt or incented to stop buying them as the yield curve flattened, because they were basically making a carry, taking on a carry trade. And then some regulatory issues where banks either were getting close to or were afraid of getting close to regulatory limits on leverage that the treasuries counted against, and they backed away from that market. And so ultimately, that was the supply-demand dynamics that fed into the repo rate spike that forced the Fed to grow their balance sheet to ameliorate the problem. And it also eventually led to, as we saw in April of last year, a suspension of some regulations as it related to treasuries for the banking sector in the U.S., the SLR regulations, which meant that the Fed, U.S. banking system, under certain circumstances, wouldn't have to count treasury bonds against their leverage ratios. So some of the leverage constraints have been removed. The yield curve has steepened, and so there has been In theory, some of that leverage trade has been brought back, that hedge funds could be marginal buyers. FX hedge treasury yields, particularly for Japanese buyers, but also for Europeans, have risen significantly. They are positive again. We wrote about this a bit in last week's Treasurys report. And so in theory, marginal foreign buying of treasuries is probably up and certainly better than it was in September of 2019, given where those FX hedge treasury yields are. And so it really is and those importantly are a function of the dollar falling. The dollar was 98 or whatever it was in September 19. It's 90 now. So it's a fluid situation. Ultimately, the underlying fundamental problem is size of U.S. Treasury issuance, how much of that issuance is being done at the short end. And as we've shown that 75% plus as of a few months back was being done at 6 months or less. The question then is why is the government issuing so much in the Treasury market at 6 months or less? And there's really only two feasible reasons in our view. Number one, Treasury doesn't know that it's the best time in 100 years to extend maturity as far as they can, which strains credulity. Or the demand, the amount of demand for long-dated U.S. Treasuries is not nearly what people say it is. And that's really the only possible explanation. So they keep issuing this stuff at the short end because there's not a strong enough bid at the back end. If they try to displace too much of this at the back end, yields will rise significantly at the 10-year level, which is really your policy rate for the government. They will hurt the housing market, hurt the economy, and so they're stuck, basically. So that is going to be the challenge of trying to manage those factors, and they all sort of move around depending on what the dollar does, depending on what issuance does, depending on what the economy's doing, et cetera. So hopefully that gives you some sense of sort of the factors to watch, and what the dollar does gives you a really good sense of how tight the liquidity is around all of that. Let's see, from Jeffrey, thanks for all your hard work. Please, you're welcome. Thanks for tuning in. Please discuss inflation in regards to the U.S. dollar being devalued and the economic consequences. So all else equal, the dollar goes down, inflation will go up because we import whatever we import, call it $500 billion a year in goods. And so if the key is you got to get inflation up, and then you have to not allow interest rates to rise commensurate with that rise in inflation to offset the gains or the benefit of delevering from the higher inflation. And that's where the yield curve control comes in. So it really speaks to a way to delever the U.S. government, to delever corporates, consumers, households, on the backs of the real purchasing power of bondholders. That is the game plan. It speaks to owning assets that do well when real interest rates are negative. And so they've been trying to do that. They've had some success. There are more aggressive things they could do in theory. But that's the dynamic of what the consequences would be. It's a hoped for slow delevering of the balance sheet without having to do a massive devaluation all at once. Any thoughts on the GameStop squeeze? It's interesting, just in terms of, I think people talk about the decentralization of finance around DeFi and Bitcoin and crypto, but I think this is another example of it where you've got basically a swarm of people on Robinhood able to log in on Reddit and basically short squeeze a major hedge fund. It's just sort of interesting. It's kind of a fourth turning thing as well. From Jim, please explain the mechanics of paper gold contracts controlling gold prices. Yeah, so it's the easiest way to think about it ultimately is if there is demand for gold, there are two ways to address it. You can have the price of the underlying gold go up, or you can have the number of claims on the underlying gold go up. And historically, because gold is centralized, and the sort of the central ground zero for all of this is the London gold market. It is what has happened is the amount of paper claims on gold have been allowed to rise significantly. There are no great data sources on how big that leverage is, and so that is how it is used. Is basically the expansion of paper leverage instead of the rise in prices. Let's see, from PV, you often mention that the Fed is cornered in supporting equity prices as they are critical to U.S. GDP. Can you please elaborate on the connection between equity prices and GDP? Yes. So net capital gains plus taxable IRA distributions are 200% of U.S. personal consumption expenditure, or PCE growth. PCE is 2/3 of U.S. GDP. And so ultimately, it is mathematically difficult, if not impossible, for PCE to rise if stocks aren't rising and asset prices aren't rising. And if PCE isn't rising, it's mathematically difficult or impossible for GDP to rise. And if GDP doesn't rise, tax receipts don't rise. If tax receipts don't rise when you've got 135% debt to GDP, you have a debt crisis. And so basically, through a multi-step daisy chain, falling stocks will result before very long in a debt crisis for the United States. As people would say, well, a hallmark of a debt crisis is rising yields, rising treasury yields while stocks sold off. I would say you're right. And I would say that's exactly what happened March 9th to March 18th, 2020. And I would say that's exactly why the Fed stepped in with $625 billion per week, an unprecedented amount to stop that from happening. You've mentioned the multi-currency pricing of oil helps explain why oil price is so low. What impact have we seen on yuan pricing of other commodities? Great question, Hussein. So far, it has not been the same, I don't think. Quite frankly, I've not spent as much time on iron ore and copper because those are two of the other big ones where I've seen the contracts. I think they're at a younger stage. All else equal, you would expect the same dynamic to happen, which is to say, unless the dollar falls, those commodity prices won't rise that much. But I just haven't done that much work on those. I've been more focused on the oil side. Let's see, from Michael. Can you comment on the velocity of Bitcoin? 300,000 transactions daily, 110 million annually at 20,000 each is 2.2 trillion. Yet only probably 10 million Bitcoin actually circulate due to what has been lost and savers. This is the one piece of Bitcoin that I just can't wrap my head around from a valuation standpoint, especially in light of Lynn Alden's recent valuation piece using quantity theory of money. Thanks for the consideration. Love the reports. Thank you, Michael. This is the first time I've looked at this, so it's a very good question. I haven't had a chance to read that from Lynn yet either. Let's see. For me, I guess ultimately it comes out in price, and I think speaks to the volatility we've seen, where you'd expect to see massive volatility given sort of the relatively big volumes flowing through the relatively small amount of Bitcoin that you highlight. And so I think that's probably, without having a chance to dive through all of that, to me, what those numbers say to me, gut instinct, is that volatility of Bitcoin is likely to remain high given those dynamics. And that ultimately, as Bitcoin's market cap rises on high volatility, that volatility should over time shrink as in theory, the transactions and velocity as a percent of market cap shrink as the price rises. So that's how I would answer that. But that's a great question. Let's see, from Max. Max, how are you? Thoughts on Bitcoin. Thoughts on PBOC stance this week. Easy for me to say. Draining liquidity, less accommodative, talking about slowing froth in markets. It's very interesting to me. I was looking at a chart today that showed the repo rate in China at 2.75% and the repo rate in the United States at -1 basis point. And I think some of what is going on, I think they probably are trying to drain some froth, but I'm also wondering if this isn't part of sort of ongoing capital/currency wars where you're seeing both sides, the U.S. and China. The U.S. has had, as we've written about in our work recently, several different policymaker comments and op-eds talking about the need to effectively prevent or begin to get concerned about the amount of capital flows flowing to China. For example, Goldman Sachs said last week or the week prior, they expect $140 billion of bond flows to China this year, which that's the way certain U.S. policymakers look at that, I suspect, is that's $140 billion that should be flowing into the Treasury market that are not, because China offers a better rate. And so after adjusting for the currency. Is this China? To me, it's either China just doing what they're saying they're doing, which is draining liquidity, trying to take some froth out, or trying to maintain an advantage of being more attractive source or destination, for capital. Hi, Luke. Love tree ring from Dean. Hi, Luke. Love tree rings. Thank you. How does holding a gold affect the balance sheet of a commercial bank like JP Morgan? I believe it is still held as an asset. I believe it's lumped in with FX at this point, and so there are a haircut for holding it. And I don't have more details than that, unfortunately. Is how it would be treated at the commercial bank level. From Max, what are you looking for in Fed minutes tomorrow? Are they really going to shoot across the bow with a taper tightening hint? Gun to my head, no, I don't think they will. But I'm the old two-handed economist rather than one-handed. I don't think they will, is the short answer. I think they are trying to string this along as long as they can. I think they want to try to jawbone without jawboning to try to restrain some of the levels of froth that we're seeing across a number of different asset markets without actually having to go all the way to, hey, we're going to taper. But I'll be watching it with great interest. Expound on your recent comment about Midwest real estate feeling as bubbly as some stocks and sectors. Thoughts on reasons behind it, especially with rates rising quickly. Yeah, so recently I've noticed that it's not just, we're seeing things in Midwestern housing markets that have long been sleepy. Parma, Ohio, Indianapolis, Indiana. I saw one in my Twitter feed, Omaha, Nebraska, where you're seeing bidding wars, houses going for $75,000, $50,000 over asking, all cash, etc. And what I think is happening, at least in part, is that baby boomers own some big chunk of the $30 trillion plus in retirement assets. And once they reach a certain age, they have to have a required minimum distribution, works out to about 3% a year, 4% a year, starting at age 70 and a half. So as boomers get to 70 and a half, they got to start taking out in aggregate, let's say they own 20 of the 30 trillion. So they got to start taking out 600 billion to 800 billion a year mandated. They can throw some of that into bond markets, or if they have concerns about currency or are paying attention to what's going on, or just don't like the fact they're getting paid no yield in the bond market, they might consider buying a house for rental properties. They might consider buying a house for their kids. And I think that is what is happening. Hi, Luke. You often mention that you invest in gold, silver, and Bitcoin and tech stocks. Are you not worried about a market crash when it comes to tech? How are you protecting against this highly inflated market? For me, I'm just looking at things on a relative basis. And to me, the issue, it always comes back to the biggest bubble is the government bond market, where you have a debt to GDP of 135%, obligations of another 500 to 1,000%. And so you have this need for to keep rates from reaching any market level. They have to be kept at politically expedient levels, which suggests an ongoing need for negative real rates and increasingly negative real rates as the debt and obligations increase. So for me, it's really it comes down to, would I rather own a share of Microsoft or a Treasury bond? Microsoft. Would I rather own a share of Google or Treasury bond? Google. Would I rather own Intel or you get the point. There are some of the more frothy ones that I probably, there is a level on yields where that would start to reconsider. Or if we see we've seen the early phases of a reflation trade, and that's, we've always said, hey, I like industrials, I like tech. I think the industrials would continue to benefit from a reflation trade. You'd maybe move some into there, but that's how I think about the high levels of valuation of tech relative to the higher levels of valuation implied in government bond markets. From Ian, is there a scenario where the dollar, gold, and Bitcoin go up together? Yes, I do. I think ultimately, if you get a situation where something happens in the Eurozone, something happens to China, then I think you could get those things happening. I think if you had some sort of other I don't know, some sort of big sovereign risk off where you basically are forcing an unwind in the dollar market, but it also concerns the U.S. So the dollar is the cleanest dirty shirt in fiat. But then you also still have people interested. There's wanting to be hedging or a realization that if the Eurozone blew up, dollar would go up. You might even see gold go and Bitcoin go down initially on that. But I think people would very quickly realize it's only a matter of time till either authorities step in or until the banking system in the U.S. has a problem, and that requires a response. Ultimately, I do think you can see that, but I think it would probably be fairly short-lived. From Derek, thanks for your hard work. You're welcome. Thank you. Unfortunately, in Canada, the maximum mortgage term is 10 years. Based on your various potential outcomes, do you envision G7 central banks and governments being forced to drastically raise interest rates within 10 years? 10 years is a long time. I would answer it this way. I don't think they can drastically raise rates until the underlying fiat currencies are significantly devalued to reduce the real interest rate burden of governments themselves, because otherwise drastically raising interest rates is only going to bankrupt them, and they won't go bankrupt. They will simply have the central banks print what's needed. So that's until currencies are significantly devalued, I don't think that'll happen. How do you envision KYC impacting Bitcoin? Do you have a view on timing? From Dan. I think KYC's already started. I don't think it's a bad thing that they have KYC. I think that will bring more institutions into the market. And so to me, there's probably this gap in time from KYC as it gets big, begins to hurt the highly levered or the rumored to be highly levered offshore Bitcoin market. And that could cause some downside, I suppose, in the near term. But ultimately, it's sort of this baton pass from that market, the offshore unregulated market, to the onshore regulated market, where there's a lot more dollar flows. There's a lot less leverage. In theory, that would be good for price. It'd be good for volatility. In other words, reduce volatility over time, both as price rose and as they were less levered flows moving into Bitcoin. So I think I don't think KYC is a bad thing. I think it's a good thing. From Norm, Luke, is the Fed actually servicing the paper it has bought via Treasury issuance? So isn't this debt essentially a mirage? The Fed and Treasury can cancel the debt, leave all of their non-Fed held debt outstanding. Isn't this an option versus the draconian move for the Fed to revalue gold as a means to fund the spending needs of Treasury? Why is this debt cancellation idea not an obvious way to reduce the debt to GDP problem? I think it is probably a way you could do it. I would argue that gold and other reserve assets would respond, equities would respond were you to do that. And from what I've been told, policymakers are thinking about it in these terms. In other words, I've been told that they say only the debt held by the public matters, which tells you they're thinking along these types of lines. So it's a little bit of it's a little bit of semantics. They could certainly do it. The question then would be, would the Fed then have to buy the issuance going forward? Because people would a little bit remove, pull back the curtain or remove the mirage that they've said, hey, this is, these are separate entities. It would further tear down that wall. So I think there would be implications, but it wouldn't be as extreme as revaluing gold. I think you're right there. Thoughts on Saudi/OPEC cutting production when Art Berman said on Macro Voices, said U.S. supply is about to fall off a cliff in early 2021. Is KSA unaware, or are they adding fuel to a future short squeeze in oil price later this year? I highly doubt Saudi's unaware of what would happen with shale. Is it possible there's some sort of deal where Saudi cuts production, OPEC cuts production, while the U.S. cuts production, drives price up, and then they recycle some of those back into the U.S. For financing flows? That the quid pro quo is Biden kills shale, and then Saudi supports more with financial flows into the U.S. That would seem to be possible to me. Maybe there's something of that happening. It would speak to higher dollar oil prices later this year, were that the case. From Michael, wonder if the powers that be plan on including Bitcoin and or gold in SDR somehow during some sort of great reset. To me, if you include gold in the SDR and make it convertible, you might as well only make it gold, because everyone's going to want to try to convert it for gold, everything else for gold, because it's sort of the hardest currency of the five within the SDR. To me, I think it some sort of maybe a link through SDR where you set the price of gold in SDRs and then everybody has to settle deficits in SDRs. That's one way of doing it. In theory, they could do it with Bitcoin as well, but I see it more likely being gold than Bitcoin. Let's see here. What happens with the short positions in gold held by investment banks if it's revalued? I think it depends on who holds the short positions. I think if the banks are short gold, I think they'll be cash settled at the prior day's close. So in other words, the people with the longs, retail investors, speculators, etc., will be cash settled at the prior day's close and not participate in the upside. If the banks are net long paper gold or net long derivative positions when a revaluation happens, I think they will get paid in whole. That is effectively what happened in 2008 with the credit default swaps, AIG, et cetera. Basically, whatever is needed to be done to keep the banks solvent will be done, is I think the way to think about that. So if they're short, they'll screw the long paper holders. And if the banks are long, they will make the banks whole. What's your view on the on the risk of a lack of collateral, treasuries for repo lending to cause serious disruptions in the financial system? How could this play out? I wrestle with this a bit. Ultimately, I guess the U.S. could certainly run a lot bigger deficits to address this. The Fed could, I think, in the short run, do reverse repos to supply the treasuries needed for this. So I think there are some things they could do. So I don't think it's a huge risk at the moment, but it's really a question that is better asked of guys like Zoltan Pozar, et cetera, than me. From Guy, it feels as if Bitcoin has free reign to run as a hedge against all this turmoil while gold is being manipulated or kept in check. Are your views changing regarding gold since it can't seem to break the mold? I wouldn't say my views are changing. My views are, I would say, evolving. That I think I had hoped gold would run as things happen. I increasingly think gold will do what it is likely going to do, in my view, all at once. So over a weekend, over a week, over a month, and people will either be there or they will not. And so it's basically, gold catching up towards Bitcoin all at once instead of moving lockstep. People like Kyle Bass and Mike Green have been suggesting the likelihood of a mark-to-market annual tax on Bitcoin. Do I see that as a possibility? I would never say never, I guess. I think it would be challenged in the courts. I'm not a lawyer, but private property has never been taxed in that way. It would be a very dangerous precedent. It would amount to property seizure by the U.S. government, and I would think it would drive $600 billion in capital associated with Bitcoin overseas at a time when the United States, quite frankly, needs the capital. So I would be surprised, but like I said, I would never say never. There we go. Okay, the Basel III. We touched on that one before. Luke, what is the best way to buy mining stocks? What are the best miner stocks? I've never gone into the individuals. For me, I've always looked at it as I want to own majors. I'm conservative. I want to own majors with most of their production in, or all of their production in, countries with a tradition of property rights and Anglo-American law. So U.S., Canada, Alaska, to reduce the risk of seizure by the government. From Max, you mentioned recently in a tweet you have solar and geothermal heating at home. Can you expound on the thought process for that? We've been looking to have an off-grid option for our home energy needs as well. Yeah, so I built my house in 2008. At the time, I thought that energy prices, natural gas, et cetera, would continue to rise. I was wrong about natural gas, galactically so. With that said, my energy bill is still, my natural gas utility bill has still risen, so it wasn't a disaster. So no, we've got a belt and suspenders and drawstring approach. We've got natural gas backup. We have geothermal primary, so we've got the geothermal lines. They do the base heating, natural gas secondary, which also warms it up. The solar panels reduce the electrical pull, and then I've also got a couple of wood-burning stoves, which So the gist of it is I've never had a natural gas bill more than probably $20 or $30 in a month in Cleveland, Ohio, and I've never had a air conditioning bill, and we run the AC all summer, that never an electrical bill of more than a couple $100. So it's really, I just thought of it as I'm going to invest the money and look at it as basically a bond where my payback comes over time in reduced energy bills, and the coupon effectively gets bigger over time as the savings increases, as there's some natural inflation that takes place with rise in my utility bills. From Suzanne, you've mentioned the possibility of the central bank revaluing gold to improve their balance sheets. Since gold is marked to market with a global trade, how could the central banks reprice it? They've got printing presses, so they could do it one of a couple ways. They could simply do open market operations in the same way that they've done with the bonds, which is we're gonna buy them, and yields are globally where central banks say yields are. Same thing with gold. Ultimately, central banks, if they wanted to, could buy gold and put the price where they want it to be. Their printing press is infinite. You could also have oil countries do this if they wanted to, in theory. I think that's where they say we now value gold at 1,000 barrels per ounce. And if they did that, it would force an adjustment in either the price of oil or the price of gold, one way or another. From Jan, the dollar's down today and the 10-year yield is trending lower, and yet gold, silver, and miners seem controlled. Any sense as to how long paper markets will control physical? No, unfortunately, it's one of these things where we've said before that it's the improving fundamentals for gold are not going to matter until they matter. And like I said before, I think increasingly, we had a nice run last year in gold, but I think increasingly it's looking like they may matter effectively all at once. From Antonia, how could gold be revalued much higher with no regard to the production cost? Through the printing press. If the Fed wanted to bid for gold, it could do so at whatever price. In the same way that they can set prices for bonds with open market operations. Expand on thoughts regarding Mike Green reference to marks and how that ties to separation of reserve assets from the medium of exchange. So I tweeted yesterday, there was a great interview with Mike Green, Nick Carter, that Grant Williams moderated. And I was really surprised because I know Mike's brilliant. He made this comment that was effectively from each according to his ability to each according to his need, straight out of Karl Marx, in terms of speaking out against Bitcoin as part of an argument of against Bitcoin. And to me, I just think the fix that we need to have, what has really driven a lot of the problems we have in our currency system right now, is the fact that the U.S. dollar is the primary reserve currency and the U.S. Treasury bond still the primary reserve asset. And if you separate those two, so you have medium of exchange dollar and probably other reserve currencies as well, as we talked about with multi-currency energy pricing, and then a neutral reserve asset that floats in all currencies to settle imbalances, whether that's gold, whether that's Bitcoin, whether that's SDRs tied to one or the other. Ultimately, that then would allow the dollar to weaken as we run deficits and allow us to compete and begin producing things again. Because as we ran deficits, we would need to buy more and more of the reserve asset, or excuse me, we'd have to settle more and more of the reserve asset, or our currency would fall against the reserve asset, while as the creditor arrangements would rise versus the reserve asset. And so the dollar would get more competitive vis-a-vis our creditors like the yuan, like the euro. And then we would be able to rebalance trade a bit more and rebalance our economy, rebalance some of the politics a lot more. Let's see, where would the gold come from for the Fed to buy it? All the gold in the registered category at the COMEX is only 95 billion at 5,000. The manual is basically remonetizing the gold sitting in Washington, or the United States gold. So the 261 million ounces is what I'm referring to there. So basically, they're just talking about marking that up, and it's a way to create dollars in the TGA without a commensurate rise in federal debt outstanding, is where that would come from. So they would, in theory, be able to buy, or could, in theory, buy in the open market after that. But as far as that exercise I mentioned before about the every $4,000 is $1 trillion, and it getting deposited in the TGA by virtue of the accounting of it. That was in reference to the 261 million ounces that the United States owns. From Peter, in an insolvency crisis, do you expect the miners to also have a short-term crash along with the stock market? Yeah, I think in an insolvency crisis, if it's really bad, as we saw last March, it's dollars win in the near term and nothing else wins. And as we were saying at the time, I was quite frankly surprised how quickly it happened. But ultimately, that dynamic will continue until the Treasury market is threatened. And once the Treasury market's threatened, then those dollars will come fast and furious, which is what we saw last March. From Mike, hey, Luke, least to most probable in your opinion, lower dollar and higher equities, vice versa, or same direction, either up or down? It's a bit of a trick question, Mike. It's tough from a standpoint of least to most probable. So in the short run, lower dollar and higher equities. I actually think in the short run, higher dollar and slightly lower equities is more probable than lower dollar and higher equities. But then I think the further out you get, I think once you start getting a little bit lower equities, then you're on the clock for lower dollar and higher equities. I think the Fed is trying to manage between these two, and we'll see how much longer they can keep this going on. But that's really been the dynamic for the last 5 or 6 years. Stronger dollar, weaker equities, and then weaker dollar, stronger equities, and vice versa. And these cycles keep getting shorter and shorter and shorter. And at some point, then I think the rubber is going to meet the road, and you get ultimately much lower dollar, probably much higher equities. But there's a way you could get much lower dollar, much lower equities, depending on what happens with capital flows. You recently mentioned that you are buying more Bitcoin. You're not a financial advisor, but can you tell us what's your personal allocation of Bitcoin and gold miners versus stocks other? I would lump it is probably between gold miners and Bitcoin. It's probably in excess of 25% at this point relative to stocks and everything else. And that's of my liquid investable assets. I've got, when you look at FFTT and other as a business I own, I don't include that in that number. Understand the process of reducing debt via yield curve control and inflation, as well as global reserve regime change, wondering how much consideration you give to being in a purely fiat world now, perhaps reducing the downside risk and prolonging the slow growth process. Let's see. The process. To me, that's when you talk about reducing the downside risk, that's really what this is. The fiat expansion has all been about. Ultimately, I don't think the central banks are bad guys. I don't think they're trying to increase wealth inequality. I think what they're trying to do is prevent a catastrophic delevering of the system where unemployment is reduced by reducing the denominator. In other words, unemployment is number of people unemployed over number of people. And I think the thing that scares the central banks more than anything, and what they're trying to do, is prevent the unemployment rate from falling in a severe depression by having the number of unemployed stay where it is, but the number of people in the denominator shrink due to just severe deflation, unwind, et cetera. That's what I think they are concerned about. And so I do think that the fiat central bank expansion game, debasement game, is really all about that. That said, they run a fine line, because if they go too far with that game and you get into a disorderly dishoarding of fiat currencies, then you run the risk of the same type of problem, except via hyperinflation. From Bruce, what are your thoughts on the Fed quietly announcing just before Christmas it will change the way it reports money supply, grouping M1 and M2 together, as well as reporting once a month versus currently every week? I hadn't noticed that, Bruce. Thank you very much. No comment. It's interesting to me, but that's the first I've heard of it. All right, last couple here. I apologize, I'm not going to be able to get to everything, but I know we started late, so I wanted to make sure to run a bit long here. Last couple. To confirm, is your base case real demand pull inflation or some kind of stagflation scenario? I'm struggling to get my head around how demand pull inflation can happen in a debt-based economy where the only entity taking on new debt is the government, who will most likely renege on their obligations to the central bank, and with credit contracting in most sectors other than housing. My base case is that for inflation is that the government is growing rapidly as a percentage of the economy, government bank sector loans to the U.S. government are rising rapidly as a percent of total bank loans, and we're going to hit a tipping point on current course and track where the government becomes a big enough for the majority of the economy and of bank lending. And suddenly the measure that most analysts and macro analysts, economists have been watching for inflation in the United States, which is what is private sector bank lending doing, becomes increasingly irrelevant, because what becomes the key driver is what is the U.S. government doing? And it's very much a U.S. economy with Chinese characteristics model. It's very much centrally planned. But if the U.S. government is spending all kinds of money, and the U.S. government goes from 22, 24% of GDP today, bank loans to the U.S. government are rising 35 to 40%. It's not going to take that long for the U.S. government's deficits, particularly if they're handing out money to people, increasing amounts, doing UBI, to begin showing up in real world supply demand dynamics. And then layering on top of that, the currency depreciation induced inflation as a result of what is really an ongoing and accelerating move away from the dollar in global energy markets, global FX reserves, et cetera. So that's why I think we're in this sort of transition from no inflation towards inflation. And that's my base case. For me, the only question is how long will it take? And I think it's going to become much more obvious as we move through 2021. Then when we get into 2022 and into 23, I think it gets really obvious and things get interesting, because then you get into, okay, rates rise. Paul Volcker ain't coming this time. Fed's going to have to come in, cap rates. And that means the Fed's balance sheet's going to have to rise faster, not shrink, in response to inflation. So people are thinking this inflation is going to be a little, and then kind of up a little and linear. And I'm thinking it's going to go all at once. Okay. From Ben, Luke, Lagarde and Yellen have not mentioned gold, but appear worried by Bitcoin. This indicates they believe they have complete control of gold. Agree. Can they paint the tape enough to dissuade gold bugs and use Bitcoin interest to distract and help before hitting Bitcoin with regulation? I think possible. That might even be the game plan. Ultimately, the challenge they have with Bitcoin is it's hard to have these derivatives, the unallocated expansion and the cash settled derivatives, and the way they do with gold, because it's easier to buy physical Bitcoin, an actual Bitcoin, than it is with gold, right? I can get on my phone here and buy a Bitcoin if I think the price is down a whole bunch. And I can buy gold if the gold price is down, but that's just paper gold. Buying physical gold is sort of difficult, which I think is one of the attractions of it. But ultimately, this centralization of gold makes it easier for them to manipulate gold, and the decentralization of Bitcoin harder for them to manipulate Bitcoin. All right, and let's see here. One more from Dean. Can the U.S. do anything to lower the dollar slowly, given that all of our trade partners have figured out to combat that via U.S. asset purchases? I think they've been trying to do it. It's just been sort of choppy, where the dollar gets lowered, and then, quite frankly, it feels like they've tried to support the dollar, they being the U.S. At key points. I think the world is moving away from the dollar. It's interesting. Treasury purchases since 2014 by foreign central banks are at net zero. They haven't bought a single treasury bond in 7 years. And so, it moves up and it moves down, but ultimately you're seeing a steady move away from the dollar. And so to me, it's more the US doing things to manage the rate of decline rather than the other way around. So with that, I am going to wrap it up for here. I've been going for a little over an hour. Again, I appreciate everyone joining and really appreciate the opportunity to interact with everybody. These kinds of sessions are my favorite to do because it's just informal. And we can kind of bring up the issues of the day. So thank you, everybody, again, for being on our mailing list, for being with FFTT, and for this conversation. And I look forward to chatting with all of you very soon. Everybody have a great night.